Well, as I say there, Safaricom posting lower than expected earnings for the first half through to September. And it's really competitive pricing on the one hand and then higher costs on the other that have come to bear on the business. Safe to say that you're operating in a pretty challenging environment right now, right?
It's been challenging for the past 12 months. You know, it's a little bit of competitive pricing, but it's actually quite a lot about the macro. The shilling has devalued significantly in the past few months. And of course, we've also had big challenges with the price of fuel. And we're running our generators typically at 2 hours a day. And so as fuel has moved from 90 shillings to more than 122 shillings, that's had a very big impact on us.
With those external factors coming to bear and the company itself having very little control over those factors, where exactly are you looking to cut costs and improve efficiencies in the business?
Well, we're driving revenues, and we've been driving revenues pretty hard in the last couple of months or so, which is why you've seen revenues actually increase by 5.3%. And in terms of cost, we've actually started to implement some stuff. So we're now outsourcing the managed services. We've changed the way we're bringing products into the country, so less air freight and more sea freight. We've reduced the cost of site build. So those costs are going to be feeding into the second half to really try and counteract the externalities.
Okay, well, let's take a look at pricing pressures there, because you say that it's brought a little bit of pressure to the business, but we know that Safaricom is operating in a very competitive environment right now. We've seen price wars or these cellular operators or mobile operators like yourselves getting engaged in price wars pretty extensively. So to what extent has it come to bear on the business?
Well, prices have dropped from by about 80% on last year. And what we've seen in this last 6 months is we've seen the full effect of the harsh end of the price war. So last year when I sat here, the prices just moved down to 3 shillings. By January, the prices moved down to a shilling. And even now, we still have prices which Safaricom, still have prices which are less than a shilling. So moving from 8 shillings average this time last year to, we've actually just moved the price up in the past month or so, but to around 3 shillings, I mean, of course, that has an impact on revenues more than anything else. It
also then places a lot of emphasis on, the company needing to derive revenues elsewhere. So let's take a look moving forward. I mean, you've got voice coming under quite a bit of pressure, but data seeming to be the next leg or growth curve, offering that next growth leg for the company moving forward.
Yeah, data, including M-Pesa, has been fantastic. We've seen data representing about 31% of the total revenues, which actually for most mobile operators, that's quite a lot. We have a head start on the competitors because, we do have the cash, we have been investing. We brought forward our CapEx to the first half. We still expect to come out at the end of the year with a CapEx intensity that we went into, which was about 25%. So 25 billion shillings is what we're going to spend on CapEx, although we front-ended that. And we front-ended that so we can do things like, we've launched, for example, Africa's largest indigenous cloud a few weeks ago. And all of that is really going to start to accelerate the data business for us. M-Pesa continues to perform, well, really, I would say, outperform our expectations, really.
And still all within Kenya's borders, Bob?
Yes. We've got our own challenges here in Kenya, so I think we'll just stick to making sure that we retain a leadership position in this country before we start to think outside of Kenya.
Okay, so lots to concentrate within Kenya. Let's take a look at the outlook moving forward then, because many asking the questions of, what are the chances of reporting robust earnings growth in the 2013 financial year?
I think we retain our original guidance, which is that our EBITDA will come in between, low to mid 30s. Growth will be in the high single digits. And actually, growth was in the high single digits in revenue, top line revenue in the first half. So provided we can get the costs under control, which, we've already started to put quite a lot of those things in place. The managed service contract, for example, kicked in from the 1st of October. We've increased our prices from the 1st of October as well, so that is now feeding through to stronger revenue for this first month of the second half. And as we move forward, we would want to be stabilizing our EBITDA in the mid-30s. We will want to keep our revenue growth. It'll be single digits. I don't think we're in the double digit phase any longer. And we will see data taking an increasingly large part of that revenue as we go forward. CapEx needs to come down. So it's currently sitting at about 25% intensity, but we will see that coming down to European norms as we move into 2013 and beyond.